Hello everyone and welcome back to Explain the Charts. Today is Friday, November 21st, 2025, and we are diving into an in-depth analysis of the Nasdaq 100 ETF, ticker symbol QQQ. The big story is yesterday's absolutely stunning reversal across the board. Major indices, led by the Nasdaq, experienced a dramatic round trip, starting the day with strong gains of over 2% before closing down more than 2%. This massive intraday swing was initially sparked by blockbuster Q3 earnings from NVIDIA, which beat expectations and gave a strong Q4 outlook. CEO Jensen Huang even directly addressed AI bubble concerns, reinforcing bullish sentiment in the morning. However, the rally was completely extinguished. Multiple sources point to a sharp drop in cryptocurrency markets, with Bitcoin falling to its lowest levels since April, which soured risk sentiment. More importantly, the long-delayed September jobs report came in much stronger than expected, showing 119,000 jobs added versus the 51,000 anticipated. This surprisingly strong data significantly lowered investor expectations for a Federal Reserve rate cut in December. The odds, once near certain, have now plummeted to below 40%, which is a major headwind for growth and tech stocks. Adding to the uncertainty, major retailers like Target and Walmart are painting a picture of a strained consumer, warning of an affordability crisis. This combination of hawkish Fed expectations, souring risk sentiment from crypto, and underlying economic concerns created a perfect storm for sellers. Now, let's turn to the charts to see exactly how this story played out in the price action and what it means for QQQ moving forward. As you can see on the daily chart, yesterday's candle is impossible to ignore. Looking at this daily chart, the long-term picture since the lows back in April of this year has been a clear and powerful uptrend. The market has consistently made higher highs and higher lows, culminating in an all-time high around the $637 level just a few weeks ago in late October. Following that peak, we saw a healthy pullback and a period of consolidation. The market then attempted to rally back towards those highs this week, which brings us to the crucial candle from yesterday, November 20th. This is a massive bearish reversal candle, often called a bearish engulfing or a shooting star, characterized by its small body and very long upper wick. It opened at $611.62, rallied to a high of $614.03, and then plummeted to close near the lows of the day at $585.67. This price action signifies a powerful rejection of higher prices. Buyers tried to push the market up, but sellers came in with overwhelming force. Critically, look at the volume bar at the bottom. Volume on this reversal day was immense, at over 117 million shares, which is significantly higher than the average of the preceding days. High volume on a down day, especially a reversal day like this, adds significant credibility and conviction to the bearish move. It suggests that large institutions were actively selling into the morning's strength. This has now established a formidable resistance level at that $614 high. The immediate support level to watch is the low of that candle, right around $584.75. If that level breaks, our next major support zone comes into play between $570 and $580, which acted as a floor for the market back in August and September. Below that, we would be looking at the $550 to $560 range as the next line of defense. This single day has dramatically shifted the short-term technical landscape from bullish to bearish. Now let's zoom in on the price action over just the last month to really appreciate the significance of this event. Here we can clearly see the final push-up to the October highs, the subsequent pullback, and the attempted rally over the last week. Yesterday's candle didn't just stop the rally, it violently reversed it, wiping out the gains of the past week in a single session. This type of price action is often indicative of a bull trap, where the market looks poised to break out higher, drawing in buyers, only to reverse sharply and trap them in losing positions. The psychology here is a rapid shift from greed and FOMO in the morning to outright panic and fear by the close. Switching over to the 1-hour chart gives us a more detailed, play-by-play view of how yesterday's reversal unfolded. You can see the market gapped up significantly at the open, fueled by that pre-market Nvidia optimism. Price pushed higher for the first 2 hours of trading, establishing that daily high of $614. Then, the selling started, and it was nothing short of a waterfall decline. Look at the series of large, consecutive red candles with very small wicks, indicating that sellers were in complete control from that point on. There were virtually no meaningful bounces on the way down, as any attempt to buy was quickly overwhelmed by selling pressure. Notice the spike in volume on these hourly red bars, especially in the late afternoon. This confirms that the selling was aggressive and sustained throughout the session. The price sliced through several potential intraday support levels around $605 and $600 as if they weren't even there. This hourly view shows the sheer momentum behind the sell-off and highlights the capitulation that occurred in the latter half of the day. Finally, let's drill down to the 15-minute chart for a trader's perspective on yesterday's price action. The initial push higher after the open is clear, but the first sign of trouble was the large bearish candle that formed after the peak, completely engulfing the prior candle. For day traders, the break below the opening range low would have been the textbook signal to initiate short positions. From there, it was a classic downtrend day, characterized by a series of lower highs and lower lows. Each minor bounce was sold into, creating a staircase pattern downwards. The fact that the market closed right near the low of the day is particularly bearish, as it shows no sign of buyers stepping in before the bell. This often suggests a higher probability of downside follow-through in the next session, which would be today. The intraday picture confirms the narrative, an initial burst of euphoria that quickly turned into a relentless, high-momentum sell-off. Okay, let's go back to the daily chart to synthesize all this information and discuss the potential scenarios going forward. The weight of the evidence is currently pointing downwards. Let's outline the key scenarios and the important levels to watch. First, the bearish case, which seems the most probable right now. I would place the likelihood of further downside at around 75%. This scenario is reinforced if the price breaks and closes below yesterday's low of about $585. A break of this level would likely trigger more selling, with the first target being the major support zone between $570 and $580. Now, for the bullish case, which is the lower probability path, at about 25%. For bulls to regain control, they absolutely must defend yesterday's low of $585 as support. We would need to see the price form a base here, perhaps with a bullish reversal candle today, and then decisively reclaim the $600 psychological level. This would suggest yesterday was an overreaction, but it would take a lot of buying power to reverse that kind of selling momentum. So, to recap the key levels everyone should have on their charts. Major resistance is now firmly at the $614 high. Minor resistance sits around the $600 psychological level. Immediate, critical support is at yesterday's low of $585. The next major support zones are $570 to $580, and below that, $550 to $560. In the long term, the primary uptrend is still intact, but yesterday's action is a major warning shot. A break below the $570 support zone would be a significant blow to the long-term bullish structure. Things to watch for today and next week are simple. Does price hold $585? Pay close attention to the closing price today. A close near the lows would be very bearish, while a close back above $595 could signal some stabilization. Also, keep an eye on yields, the dollar, and the crypto markets for clues on broader risk sentiment. That's our in-depth look at QQQ. Please remember, this content is for informational and educational purposes only and should not be considered financial advice. Trading and investing involve risk, and you should always conduct your own thorough research before making any decisions. Consult with a qualified financial advisor to understand what is right for your individual situation. Thank you for watching Explain the Charts. Please hit the like button, subscribe for more content, and we'll see you in the next video.